Subprime is back and is coming to a bank near you. I'm your host, Steve Van Metre, and thanks for joining me today. The subprime housing bubble nearly took down the commercial banking system. Subprime is back, but this time it threatens to take down community banks. Let's start out with today's story. As car repossessions are surging, a troubling sign for the used car market. And repossessions of vehicles are surging and have even doubled among so-called prime borrowers, or people with good to excellent credit scores who are considered the least likely to default on their loans. Americans had temporary pockets of income during the pandemic thanks to stimulus checks, extra unemployment aid, and the child tax credit payments, allowing them to pay up for pricier cars. But those government supports have ended, and many families are now facing budget shortfalls given the highest inflation in 40 years. And as a result, more consumers are defaulting on their auto loans, with subprime repossessions up 11% since 2020. And this is significant because it's not just a matter of that consumer prices are up. If prices went up, that's okay. It's that wages aren't keeping up with prices. As long as wages could keep up, prices can go even higher, but when wages fall behind, they don't. And as a result, what we're now seeing is delinquencies turning into defaults. But the question I want you to keep in mind is, for today's show, is not which bank is in trouble, it's how many of them, because a lot of these auto loans weren't done by the major commercial banks, they're done by your small and mid-sized community banks. Let's continue on. Because these repossessions among prime borrowers has also doubled from 2 to 4% over the past 2 years, and one red flag is the rate of repossession for prime borrowers is starting to rise, and that's something that doesn't normally happen. It's not just subprime borrowers that are having problems. And the key pressures are showing up inside the metrics, where collection rates have declined to a recent 67.1%, and where the company had given a forecast of 67.6. Now keep in mind, collection rate is what you're collecting on payments. So what we're starting to see now is a third of all these borrowers are missing their payments. And that means if they continue, they're going to default, they're going to be repossessed, and the banks are going to be sitting on a lot of vehicles and bad loans. Credit Acceptance said in its earnings release on Monday that the forecast applied to consumer loans that have been assigned this year. The firm also said that the decrease would impact cash flows. No shock there. And its forecasted collection percentage was 66.4 that initially had been higher at 67.2. And the forecast miss, as well as commentary on the conference call, helped send the stock down, which is no surprise, because during the conference call with analysts, Credit Acceptance Chief Treasury Officer Doug Buss said, quote, "The end of stimulus and supplemental unemployment benefits help impact loan performance." He noted that inflation has been taking its toll even as consumers have been working through the savings that have been accumulated during earlier in the stimulus payment activity. And we keep hearing that, particularly from policymakers. We hear from the Fed that there's all this excess savings. There's so much savings that it doesn't make sense that people can't afford to make their payments. They just aren't willing to tap into their savings. Well, perhaps that savings isn't what everyone thinks. Many consumers in the United States, at least 61% of them, have little, if anything, left after paying their monthly bills. And those recurring obligations include auto loans. Drill down into the demographics, where consumers earn less than $50,000 and 77% live paycheck to paycheck. A third of them have difficulty paying their bills. And how does this all translate into car sales? Well, if we look at the charts and look at how this is going to affect the banks, well, we can see that vehicle sales have been slowing. In fact, they've been slowing since around 2016, 2017, and slowly headed lower. We see the drop from the pandemic that surged higher, kind of giving everyone some confidence of this massive rebound, and all of a sudden it's continued lower. And there's two major factors. The first one, we'll talk about the second one in a little bit. The first one is you see baby boomers retiring. And why do people need, cars? Well, the big thing they're doing with them is commuting to work. So if you and your spouse or you are not working, well, maybe you don't need extra cars. Maybe you get by in one car instead of 2 or 3. And of course, demand for sales has lowered. But that's not the only cause. We'll get into that in a moment. But if you look at what happened in the lending area, As you see loans surge here coming out of 2021 on a year-over-year rate of change, these automobile loans just skyrocketed. And again, I want you to keep in mind that a lot of these loans are done by your small and mid-sized community banks, credit unions, they're big auto lenders. Now, sure, people go to, of course, the big banks, but not as much as they go to the small community banks. And of course, they're the ones who can't absorb big losses. And if you look at inventories, you start hearing the story, well, there's a shortage of inventories, and sure enough, there are, but what does that mean from a dealer perspective, particularly when we also add on that auto inventory to sales ratio is low? And what that means is you're going to see a lot of dealers demand new products. So they're going to be ordering, putting pressure on manufacturers to supply these vehicles at a time now the banks are going to start receiving a ton of these vehicles back. Remember, a third of the people aren't making payments, and that means a lot of vehicles are headed back on, not to the showroom floor, but perhaps back to dealer lots. And from the bank's perspective, you see they're tightening lending standards here. Now, we don't have a lot of data only going back to around 2010 or 11, but the net percentage of banks tightening auto loan standards is creeping up. And why does that happen? Well, when the yield curve inverts, remember, banks borrow at the short end and lend at the long end, so it squeezes margin. And when it inverts, there's very little, if any, profit depending on what they're lending out at. So banks are tightening standards, making it more difficult for people to borrow. So if you're behind on your payments, you're trying to maybe refinance your car, well, that just got more difficult. And of course, the catalyst for all this is that average hourly earnings of all employees, you look at total earnings on a year-over-year rate of change against, or a percent change, is subtract off the consumer price index. It's been largely negative since we entered the pandemic, and after all that stimulus money passed through people's pockets, now it's popped back up here recently, and that's only because inflation has come down, as we talked about on our show the other day. Now, that doesn't mean for families all of a sudden it's like, ooh, big sigh of relief. Boy, prices stop going up, and I'm going to be okay. It just means that for the first time that wage growth is now higher than inflation, but overall there's such an impact, and we'll talk about this in a future show, that there's other shocks coming to consumers' pocketbooks which they're not going to be able to absorb, and doesn't mean that just because all of a sudden in 1 month their wages look better that they're going to be able to keep making all of these payments. Because here's the real story. When we look at total vehicle sales and compare it to the 4-week moving average of initial claims, now shown in red, and you notice that as people go back to work and claims are going down, vehicle sales go up. And it kind of makes sense. They're almost a mirror of each other. You see claims falling, vehicle sales up. But as soon as claims start to rise, notice vehicle sales start to slow down. And the more the claims go up, the bigger the drop off in sales. Because if you're not working, you don't need to buy a new car. And you can't get the financing. So you can see in the great financial crisis, claims went up, sales went down, and we're starting to see this trend in sales go down, suggesting that we're in a broader bottoming pattern here of initial claims, and that we're certainly going to see claims headed higher, suggesting the economy is in far worse shape than people predict. Now, if you're concerned at all what a devastation of defaults could mean to the community banking system in your portfolio, well, you shouldn't be. I'll put a link up here in the corner for Portfolio Shield and description below, because it's not just the auto market that's taking a hit. The real estate market is next on the list as U.S. inventory soars at a record rate, with U.S. buyers pulling back. The slowdown in demand means more properties are being left on the market, which gives buyers some negotiating power. And the number of active listings nationwide jumped 31% from a year earlier, a record high increase for a third straight month. Now you say, well, that's not bad. That's maybe a good thing. There's been a shortage of inventory. But remember, when more people start to sell, what does that usually do for price? It comes down. And if people have borrowed at these peak prices and start to get underwater, well, now all of a sudden, if they lose their job, they might reconsider making their payment. Because remember, back during the great financial crisis, people stopped making their payment, and several years later, they were able to buy another house at a lower price. They may do that again, putting even more stress on the banks. But if you think any of this is going to give the Fed reason to pause, well, you're wrong. The Fed is likely to want further evidence of inflation slowdown According to Nick Timmerus of the Wall Street Journal, as easing in price pressures last month followed reports of stronger than expected wage growth, which will remain a big story, complicating the rate-setting outlook. Wednesday's inflation report keeps the Fed's door open to half a point rate increase in September if subsequent data confirm price pressures are easing, but a 75 basis point remains possible after recent reports of accelerating growth in jobs and wages point to significant income gains that could sustain stronger spending and higher prices. And of course, if you focus on the non-farm payroll report and you're not looking at initial claims, you completely miss the boat, because as I talked about on a show recently with Jeff Snyder, our chief strategist, and his buddy Emil Kalinowski, that the non-farm payroll report is deliberately smoothed out, so it's supposed to pop back up if it drops quite a bit and then slowly come back down, as of course the data suggests. But speaking of our chief strategist, Jeff Snyder, said there's major problems in the T-bill market as the collateral shortage is getting worse, and it has an impact and is telling us what we're missing is there is a collateral shortage. Another blistering T-bill auction overshadowed by the long bond sell, he writes in his daily, as collateral scarcity remains a serious issue with deflationary risk over the preceding several months. Reality, not a mere risk as we head into, of course, the second half of the year. You want to read more about what our chief strategist has to say, Markets Insider Pro, there's a link in the description below, because what he's suggesting is a deflationary shock is coming by the end of the year. And perhaps the Fed has one more hike and then they're done. And if what we're seeing in subprime default in the auto loan is just the beginning, we'll wait till it picks up steam. There's a full-blown crisis coming soon. I'm your host, Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.